David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, and thank you for joining me again today. If you've been watching our video and podcast series this year, then you know that we have paid particular attention to many economic metrics as we have observed the closure of the United States economy, its reopening, and looking to those metrics for direction as to market exposure and investment opportunities. In today's video, we're going to discuss the problem with the letter V. In April, the widely held opinion was that we would not experience a V-shaped recovery in either the economy or the market. Indeed, that seems to be exactly what is developing before our very eyes. You're looking at a graphic that I have drawn on the board of my conference room that depicts the economic cycle. There are certain economic exposures that you want to have during certain periods of the economic cycle and others that you want to avoid. Part of my job is to analyze information at hand and help clients understand where we are in the cycle, and by extension, where should we have assets allocated as conditions change. 5 months ago, the question was, where do we emerge in the economic cycle as the market reopens? Is it really possible to shut down the economy and then turn it back on again? Clearly, that road was not very well lit at the time, but over the months, we have had a slew of economic metrics to guide us toward the most educated answer. Today, I'm convinced in the thought that we have indeed reemerged with the growth phase of this economic cycle intact. Before we progress further, let's take a quick look at where we are in the market. As of the 26th of August, the S&P 500 index closed with a value of 3,478 points. That is a 58.74% gain from the intraday low that we observed on the 23rd of March. I'm a visual person, and clearly this graph depicts a letter V that very, very few, if any, experts suggested that we would observe just 5 months ago. Many of my clients are asking if this market resurgence is real. They want to know what might be driving this market momentum. Again, I turn to the letter V, keeping in mind that sometimes that letter can be inverted. You are looking at a graphic of the 4-week moving jobless claims average. That curve is 82% lower than it was at its peak on the 18th of April. There is only one thing that could make that curve decline so sharply and over such a short period of time, and it is simply because people are back to work, and by the millions. Do you notice the inverted V? Over the last 90 days, according to the Labor Department, we have created 9.33 million payrolls. Clearly, that means more income and less dependency on government aid. By extension, that implies that consumer confidence is stronger today. What do confident consumers do? They spend money. Now you're looking at a graphic of durable goods spending by households. This would include refrigerators, cars, boats, and other long-lasting durable goods items. Do you notice the letter V? On the corporate spending side, we can also discern a similar V-shaped pattern when it comes to capital expenditures. Recently, 2 of my clients retired, and in the process, they sold their primary residences. Both sold their homes for a greater amount for which it was listed, and they described a bidding war among potential purchasers. Now you're looking at a graphic depicting existing home sales for the month of July. Toward the far right of that graphic, can you pick out the very pronounced and capital letter V? I'm sorry, but people generally don't get into bidding wars for houses when the economy is going backwards. Continuing with consumer sentiment, now you're looking at a graphic that depicts retail sales. Again, sequestration while flattening the curve did not quell consumerism. It was simply redirected through other channels. Again, can you discern the letter V in this graphic? People who are poor in spirit and poor in wallet generally do not establish historical patterns of spending as we observed in May of this year. This graphic is not a characteristic associated with an economy in decline. Now you are looking at a graphic that we have observed within other videos of the TED spread. As we have previously discussed, this is viewed as a proxy of sentiment for the bond market. In general, if the perception is for improving economic conditions ahead, then you will have a very tight TED spread, which we can observe today at 16 basis points. Can you see the very sharp inverted V on this graphic? The bond market, as evidenced by this graphic, clearly expects the continuation of strengthening in economic conditions. But back to the question that's being asked about smoke and mirrors. Is this market movement real? Now you're looking at a graphic that depicts the Purchasing Managers Index for nations ranging from China through the Eurozone to the United States. Any reading above 50 indicates expansion, while readings below 50 indicate contraction. This is a quantifiable look into the industrial output of any given nation. You're either making things or you're not. Clearly, we have seen a strong resurgence from recent low points to where we are today. By extension, this indicates that people are actually in the factories making things for which there is strong demand, and because readings remain above expansion levels, we can assume that no resurgence of COVID-19 has interrupted that progress. So in conclusion, be very wary about haphazard predictions concerning the letter V. Clearly, we could not predict this 5 months ago, but likewise, neither could anyone accurately predict that we would not observe these patterns of economic recovery either. The main takeaway is that you must be mindful of the objective for which you are investing and the goal that you are pursuing. If your holding period is 10 years or longer, then you had a golden opportunity to invest through this decline and purchase shares of certain things at a low point that could result in the greatest rate of return of any share of anything that you've ever purchased. If you've missed this part of the recovery, please don't give up. Economic conditions change by the day. Right now, I'm helping clients discern where the next sets of opportunities may be found in the market as the economy continues to recover. It is at times just like these that I must separate myself from the noise and remain focused on what can be quantified. You should do exactly the same thing. Again, thank you for joining me today, and I hope this observation of economic facts helps to provide clarity as to the reasons behind the recovery in the market year to date.
David Guttery and Brandon Guttery independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.